Hello students, so today we are going to discuss basically the 2021 SL1 past paper. So before starting the past paper, just thought of giving some kind of an small advice and let's say set of advice to you, because most of the time you might think that SL1 paper is very difficult. Yes, I would say yes, but if you have done the basics, SL1 paper is no more difficult. So with that note, student, I am going to start this past paper discussion. Very important. As far as that you have covered the theory, going through the past paper also very much important in your studies, right? So with that note, students, so we are going to start. So I think already Indonesia has covered the risk of material misstatement part, and what left for me is the financial reporting part. Just to start with the introductions. So these are the general instructions. So it is an open book examination. It is already there. So you can read this off. And just to mention what are the things that I am going to cover up in this session, right? So let me start. So basically, student, we have the question number one. Question number one. So 25 mark question. In that question, part A, B and C. All three parts are financial reporting. So part A is from SLFRS 9, right? Part B is from LKS 40 and SLFRS 13, and part C is from LKS 2, right? So this 25 marks is from financial reporting. Then question number 2. Question number 2. The first part is corporate governance and ethics. I think Indonesia has covered already. And the second part, there's a question from LKS 36, right? So that particular question carries only 5 marks in question 2. And the question 3, as you all know, this question 3 is based on common precedent, right? So the question 3, of course, we have the group accounts question or the consolidation question. So we have the console question, comes up with 20 marks, and SLFRS 15 question coming up with 10 marks. So whatever the remaining question is basically from risk of material misstatement. So altogether in this particular paper here 30 and 35 marks and 25 marks, 60 marks out of 100 is from financial reporting. 60 mark out of 100 is financial reporting. So that is why, student, in SL1 paper you have to keep a balance between financial reporting and risk of material misstatement. If you have so much into financial reporting and if you have not covered the risk of material misstatement parts, you will end up with less than 50. So you have to keep a balance, because the paper is like 60 to 40 composition. The 60% is only from financial reporting. The remaining 40, of course, Indonesia has to taken care of, right? So here, with that, students, I am moving forward for the first question, right? So section 1, so we have the first question, right? So here, student, we'll read the question first. Multi PLC purchase 300 million 10% debentures in 1st April 2009. So what happened? In 1st April 2019, the company has purchased 30 million worth of 10% debentures. 10% is the nominal interest rate, right? These debentures are redeemable on 31st March 2024. So how many years basically? It is like 5 years, right? 5 years. So the tenor, let's say the tenor is 5 years. Tenor is 5 years, right? At 31 million. So what we'll be doing? 31st March 2024, this will be redeemed at 31 million, right? Interest on these debentures is paid annually, right? Paid annually on 31st March each year. So basically you have to think about whether the interest is paid in advance or in arrears. So annually on 31st March each year means basically they are paying in arrears. It means at the end of the year. Normally when it's come to leases, you might see the rent paid in advance or the installment paid in advance. But normally the financial instrument, most of the time whatever the interest you are getting at the end of the period, end of the, let's say, year, end of the 6 months. So here at the end of the each year you are getting the interest on this debenture. Multi PLC intended to hold the debenture in order to collect the interest payment and receive payment on maturity. Multi PLC intends, their intention, they are talking about the intention. What is their intention? Collect the interest payment and receive repayment on maturity. So their intention is to collect the interest, annual interest, plus whatever the repayment that we are getting on 31st March 2024, right? However, it may sell these debentures if the opportunity to buy in with a greater return arise. So what is happening? Even though our intention is to keep this particular asset, let's say until the maturity, so let's say the debenture is 10% interest carried. The debenture carries 10% interest. Let's say from the market in a particular date, we may get a debenture which is equal to, let's say, 15% interest. So then no point of keeping this 10% debenture. I may sell it and I will be using that money to acquire a debenture with a return of 15% interest. So that is their intention. We will keep it, but if another better opportunity comes, what we'll do? I will be selling it and I will be buy another new financial asset. Effective interest rate of this debenture is 10.54. Very important. Why? So normally we know, student, this is a nominal rate. Nominal rate will not be the rate that we are using to accrue the interest, because SLFRS 9 clearly says we need to use the effective interest rate to accrue interest, not the nominal interest rate, right? Fair value of these debentures as at 31st March 2020. So one reporting date, 31st March 2020, was 30.5 million. As of this date, 30.5 million, right? As at 31st March 2021, another reporting date, the debentures had been impaired by 300,000. Impaired. So impaired means what? ECL, expected credit losses, by 300,000. Fair value of the debentures as at 31st March 2021, 29.9 million. 29.9 million. Here we have 300,000 impairment or expected credit loss allowance as at 31st March 2021. On 1st April 2021, Multi PLC sold the debentures at 29.9 million, which is same as the fair value as at the 31st March 2021. Right. Now what they are asking? Advice on the accounting treatment to be applied for the above debentures together with the calculations required up to 31st March 2021. Up to 31st March 2021. So basically they are not asking what is happening on 1st April 2021. They are asking up to 31st March 2021. Very important, student. So here most of the time, when we are going through the past paper, what is happening, student, and when we are looking at the examiner comment also, most of the time the examiner is telling students are not producing what actually the examiner wants. Why? The main reason is you don't get a good understanding about the action verbs. So what are the action verbs? Advice. So every question, there is a verb highlighted, there is a word highlighted, action verb, right? Advice. So here what you have to do, student, basically you need to identify this is in which tier, right? Because there are few tiers given in the CA exams. So here this advice word comes in tier 5, right? So tier 5 basically evaluate. So you need to have an answer which is satisfying the tier 5. It is not all about tier 1 or tier 2, just the computation and you do that. No, you will not get the adequate mark. So you have to advise. It means you have to do the computation and you have to give elaborations further and you have to say, when this is the theory, this is what SLFRS 9 says and I have done this. Likewise, you have to evaluate your accounting application when it's come to this particular question, right? And one more thing you have to think about. Action verb and the marks allocated. Why it is important? Marks allocated. Most of the time, what is happening? Students don't know how much to write and what time that I can take for this kind of a question. Let's say 10 marks, you can get like 15 minutes, right? This is my own time, right? I have some kind of own mechanism to derive the time allocated for a question with the mark. So I am normally saying 1 mark 1.5 minutes, 1 mark 1.5 minutes. So 10 marks 15 minutes. So you have to write an answer which is satisfying the tier 5 to get 10 marks within 15 minutes. Right, student. Now we will go to refresh our understanding on SLFRS 9. So SLFRS 9 student basically has 3 main parts. I can divide, right? First part is all about financial asset, financial liabilities, classification, measurement and all those things. The other part is expected credit losses. And the next part is hedge accounting and derivative financial instrument. Hedge accounting and derivative. So this particular question basically touches this part and this part, right? So here student, when it comes to SLFRS 9, financial assets, so I am not going to define and all those things, just to refresh your mind. Financial assets, we have equity instruments and debt instruments. So equity instrument student, we know we have 2 categories, fair value through profit and loss and fair value through OCI. Debt instrument, we have 3 categories, FVTPL, fair value through OCI and amortized cost. So how to decide whether a financial asset or a debt instrument is FVTPL, fair value through OCI or amortized cost? How to decide? That's the problem. To decide whether it's a fair value through P&L or amortized cost or whatever, we have 2 tests need to be performed. The first one is called SPPI test. SPPI test. Sole payment through principal and interest. Sole payment through principal and interest. What they are asking in SPPI test, if there is a debt instrument, the entire payments are coming through principal and interest or other ways. That is what they are asking. Let's say there is a convertible debenture. Then what you can say? Convertible debenture, you have the interest, you have the maturity proceed, and you have option to convert it into ordinary shares. Then sole payment and principal through interest, sole payment through principal and interest is not satisfying. Why? We have an ability or we have another benefit to convert this debenture into ordinary shares. So here SPPI test, you ask in question whether SPPI test is not satisfying, that particular instrument goes as FVTPL. Let's say the SPPI test is satisfying. Yes. Then what is happening? When the SPPI test is satisfying, what is happening is student, you are asking another business model test. So what is happening in business model test? In business model test student, more or less here we are focusing on the payment, whatever the cash proceed we are receiving. But here we are focusing on the management intention. What is the management intention? Whether the management has intention to sell it, whether the management has intention to keep it, or what is our intention? Let's say as per the business model objective or the intention, our intention is to keep this until maturity. Keep this until maturity. Then the category is amortized cost. Category is amortized cost. Let's say as per the business model objective, our intention is to keep this until maturity or sell where good investment opportunity arise or any other opportunity arise with a higher return, then student, this should be classified as fair value through OCI. Fair value through OCI. Right. So what can I say now? Right. here based on the question student, their intention is to hold until the maturity, but if it is an opportunity to get a higher return, they will sell it. Then what it says? Obviously, this is a debenture with interest and maturity. It satisfies the SPPI test, and as per the business model objective, it is in here, and obviously this instrument should be classified as fair value through OCI. Now the problem is, when we classify fair value through OCI, how the measurement goes? When we classify fair value through OCI, measurement goes like this student. Normally, initial measurement, anyway fair value plus transaction cost, right? And subsequent, it should be at fair value. Whatever the gains and losses arising, should goes to fair value reserve, or we'll say OCI. Whatever the subsequent gain and losses arising from fair value through OCI instrument should goes to fair value reserve or through OCI. And one more thing, in fair value through OCI instrument, interest need to be recognized. Interest rate to be recognized at EIR. I will tell you when I am discussing the answer how to recognize the interest, because more or less in fair value through OCI instrument also similar to amortized cost when it's come to interest recognition. So I will tell at that point, right? So here student, those are the basics that you need to know. One more thing, selling, right? When you are selling fair value through OCI instrument, if it is an equity instrument, you know, if the equity instrument designate under fair value through OCI, or irrevocable election you have made to designate under fair value through OCI, then what is happening student? You can't reclassify the profit or loss to P&L even though that particular instrument is selling. But here when it's come to debt instrument, the rule is not that much tough. What they are saying, when it's come to debt instrument, what you have to do is, when you are selling the debt instrument, if it is fair value through OCI, whatever the previous fair value gains and losses, you can reclassify to P&L, right? So that is also there. So with that student, I will be going to the solution. So I will be taking through the suggested solution, right? Okay, don't worry, I will explain one by one everything, right? And I will move forward, right? Now here student, what they are saying, as per SLFRS 9, financial assets should be measured at fair value through other comprehensive income. I told you, fair value through other comprehensive income. How you have selected? You have basically referred to SPPI test as well as business model test, right? So here they are mentioning the financial asset is held within a business model whose objective is achieved by both collecting contractual cash flows. What is meant by contractual cash flows? Here, what is the contractual cash flow? Interest and the maturity proceed or the principal amount that you are getting after the maturity, and selling the financial asset where a better opportunity arises. So as per the business model test, right, this is the case. And the contractual terms, so we are going to SPPI test now. The contractual terms of the asset gives rise to specified dates to cash flows that are solely payment of principal. Principal means the maturity proceed, and the interest, annual interest at 10% on the principal amount outstanding. SPPI test is also done. Based on that, you have concluded fair value through OCI is the instrument, right, is the category which is suitable for this 10% debenture, right. So moving forward, Multi PLC intended to hold the debenture in order to collect the interest payment and receive the repayment on maturity. However, it may sell the debentures if the possibility of buy another greater return arise. Again, they are mentioning about the SP business model objective. Anyway, based on that, accordingly, the debenture are held within the business model, collecting contractual cash flow, selling the financial asset. Therefore, business model test is satisfied. Anyway, we have already concluded. Right? So here is business model test. Both objectives are there, so fair value through OCI is the category. The feature of this instrument is similar to basic lending arrangement. There are no contractual terms to introduce exposure to risk or volatility. There are no share options. There are no convertible options and contractual cash flows that are unrelated to basic lending arrangement. So basically, it's a basic lending arrangement. Only interest and principal is there. No any other conversion option. No any other options, right? Such as exposure to change in equity price. Let's say we had the option, share option, where the convertible debenture can be converted into shares, then equity price might have some kind of a relationship with that particular instrument. But here, this particular instrument doesn't have something like that. Accordingly, SPPI test is also satisfied, right? This is like further elaborations, right? Moving forward. Right. Now, we are coming to initial measurement. Initial measurement, I told you earlier, should be at not at transaction price, should be at fair value plus transaction cost. That is the correct way. That is what the standard mentioning, fair value plus transaction cost. So, fair value basically the purchase cost, here 30 million. And transaction cost is not applicable, not available in the question. So, initial recognition should be at 30 million since no transaction cost is available, right? At amortized cost, debt would be measured as follows, right? So, here student, I think you all can remember I have mentioned we need to have an amortization schedule as well. Why? In fair value through OCI instrument, you need to recognize interest periodically using EIR. So, to determine the interest that I have to recognize to P&L, so here the interest recognition goes to P&L, right? To determine the interest recognition, what is required is I have to maintain a amortization schedule exactly similar to amortized cost method, right? So, what I am going to do now is, I am going to prepare this amortization schedule. Why? The sole purpose of this amortization schedule is to recognize the interest amount that I should recognize periodically to P&L. Nothing else, because these balances are not reflected in balance sheet. Fair value through OCI, no, these are not reflected. Only purpose of this amortization schedule is to recognize the interest that I have to periodically recognize, right? So, here all are in thousands. So, opening balance 30 million or let's say 30,000, right? And into 10.54% EIR, don't take the nominal interest rate, right, or the coupon rate, take the EIR and 3,162, this should be recognized to P&L. What is the double entry? Fair value through OCI, investment debit, P&L credit, saying interest income, right. So, the repayment, how we have taken the repayment? 30 million into 10%. Repayment means that is what we are getting in terms of cash, right? 3,000 we are receiving and the closing balance. That closing balance comes opening balance for the next year. For that balance, you will be calculating 10.54% interest, and second year 2021, this goes to P&L. So, what they are asking in the question, accounting treatment up to 2021. Even you, during the exam, even you prepared up to 2021 and you are not prepared this one, that is perfectly okay. But here they have given this. Why? At the end of the amortization, it becomes 0 and we can have some kind of a comfort. Everything is right. So, here student, first year 2020, this should be the P&L hit. 2021, this should be the P&L hit when it's come to interest. income, right? So moving forward, right, now the real measurement comes now. Okay, now student, what is happening? Now we know what is the interest income to be recognized, but what they asking in 2020 March, what is the value should be reflected in the balance sheet or the statement of financial position. 2021 March 31st, what is the balance should be reflected in a statement of financial position, right? Here student, so I am preparing a schedule like this. So I am starting with the opening balance 30,000 and interest. So double entry, fair value through OCI investment debit, interest income credit in P&L or P&L credit, right? And repayment. If I wrote a double entry for the, if I am going to write a double entry for the repayment, what would be the double entry? Cash debit, fair value through OCI investment credit. Why? I am receiving, this is the amortized cost formula, right? I am receiving money and that's how I am going to record. And this is the closing balance as per amortized cost, Now, what is happening student? This date the fair value is 30.5 million. So 30.5 million is the value we should reflected in the statement of financial position under the heading of fair value through OCI, right? So this is not the balance. 30,162 is not the balance. It should be 30,500. Then what is happening? The difference between these two, which is 338, is going to become the fair value gain, because 30,162 need to be increased to 30,500. It means 338 is the fair value gain that you have to reflected in the financial statement. So what is the double entry? Can I show this fair value in P&L? No, it should goes to OCI credit. Double entry, fair value through OCI investment account debit and OCI credit, or we can say there should be a separate reserve called fair value reserve in the equity statement, and that reserve you have to credit 338, right? Second year opening balance is this, right? Opening balance is this, but again interest, you have to be careful. Interest need to be accrued on, not for this balance. Interest accrual not for this balance. Interest should be accrued on this balance. Why? Whatever the interest accrual goes based on amortized cost model, amortized cost formula, right? So don't come and compute interest for 30,500 into 10.54, which is incorrect. This should always follow the amortized cost formula. And repayment receiving and closing balance is this. Now we have an impairment. So I think you all can remember student, in SLFRS 9 there is a requirement for ECL, right? So equity instrument doesn't have a ECL requirement, but debt instrument always you should do ECL requirement. Why? Debt instrument also, what are the debt instrument? Debt instrument categorized under amortized cost and fair value through OCI, because fair value through P&L instrument also, even it is a debt instrument, if it is fair value through P&L, no ECL requirement comes. But here for fair value through OCI, right, debt instrument, the impairment requirement comes. Here somehow there is an impairment, 300,000. So how to record? Basically there is an impairment, always a reduction to the asset, fair value through OCI investment credit and debit to where? P&L. Expected credit losses always debiting to P&L, impairment charges always debiting to P&L, right? P&L debit. Then you get the balance after impairment, this minus this, balance after impairment 30,679 minus 300. 30,379, and now you are going to compare the fair value as at 31st March 2021, 29.9 million with this carried forward balance or the closing balance after impairment. So when you compare these two, and you will see there is a 479 fair value reduction, and what you do when there's a fair value reduction, you put a double entry. So I will be writing the double entry here, fair value through OCI instrument credit and debit to where? This is a fair value loss, you have to debit OCI debit 479, OCI debit 479. Anyway, that fair value loss also you are debiting to fair value reserve account in equity statement, right. So going forward, the student, right, we'll go forward. So anyway, mass allocation is given and all the introductions and all the information is given, 338, whatever the things that I already discussed, right. So you can read this leisurely, right. Already I have discussed these things, right. And one more thing, they have not mentioned anything about the disposal of the asset or the derecognition of the instrument. So I will tell something about that as well, because they are asking only for 31st March 2021. Right, they are not asking for 1st April 2021. So, but I will going to tell you what we are going to do as of 1st April 2021. So, this date, student, basically you are selling the asset. It means when you are selling the asset, you have to derecognize the asset. So, right, that need to be done. So, here, student, what is happening? When you are derecognizing the asset, in your fair value reserve, how much you have? Anyway, we are selling at 29.9, that is exactly similar to the closing balance as at 31st March 2021. So there is no disposal gain, no loss. Why? The closing balance at 31st March 2021 is 29.9 million, and we are selling the sales proceed also the same value, and there's no disposal gain and loss. But this fair value reserve, because the first year you had a fair value reserve, right. So first year you had a fair value reserve of here we have the amount, right. So I will show the amount to you. So here you have 330, right, 338 plus here you have 479, okay. So here is, student, what is happening? You have the fair value reserve of 338, first year it was a gain and second year it was a loss, and we'll compute the amount 338 479, and it is 141 loss is there, fair value loss is there. So what you have to do, this fair value loss, because there is a fair value reserve minus fair value reserve, that you can transfer to P&L, right. What is the double entry? Now it is not a reserve, it is not a credit balance, it is a debit balance we have. So what you do is fair value reserve credit by 141 and P&L debit by 141, right. How this 141 came? Because the first year 2020 March 31st we had a fair value gain of 338, 2020 this is the amount, 2021 we had a loss of 479, and that is how the 141 came, right. So that is done. Okay, students, right, we are going to the part B, right. We'll read. Multi PLC has investment property. Seems like we are having LKS 40 in our hands, right. Investment property in Colombo 3, which is given to various tenants on rent for commercial purpose. Investment property is carried at fair value. So basically they are using the fair value model. As you know, we can use the cost model or the fair value model. They have selected to use the fair value model. In the financial statement as at 31st March 2020, right? So 31st March 2020. Fair value of the property was 300 million. Right. Which was estimated using income approach. So what is mean by income approach, student? When it's come to SLFRS 13, if you are using a valuation technique, so valuation techniques, basically we have three types of valuation techniques or three approaches of valuation. Income approach, cost approach and the market approach. Income approach, cost approach and the market approach. So this 300 million basically derived using income approach. So income approach means basically this is a building that we have given for rent. Income approach means basically they have valued the property using the present value of future cash flows. Present value of future cash flows, right? They are mentioning considering the present value of future rental income, right? Due to adverse impact resulting from COVID-19, 25% of the total number of tenants vacated the property in April 2020. So what happened? Due to COVID-19, 25% of the tenants, they vacated the premises, they vacated the property as of April 2020. Now, whatever the income that we have received, let's say 100, now 25 move out, now we are getting 75 only, right? Further, rent concessions were given. Further, rent concession also given. So, we have given some rent concession. So, what is mean by rent concession? Let's say we are charging 100 rupees from a customer or 10,000 from a customer, there is a rent concession given. Let's say we are saying our tenants to pay only 8,000. I don't know what is the rent concession given. Anyway, some kind of a concession, relief given to tenants. Number of tenants whose business was severely affected. Fair value as at 31st March 2021 using the income approach is considering the number of tenants and rent concessions explained above was 210. So 31st March 2021, after 1 year with COVID-19, now they are assessing the fair value and it is 210 million, considering both 25% reduction in the number of reduction from number of tenants as well as rent concession. The fair value is 210 million. So we have a fair value loss basically equivalent to 90 million fair value loss. So normally what we do, if it is a fair value method, fair value loss you have to charge to P&L. You have to charge to P&L when it's come to investment property. The accountant of Multi PLC suggests the following options in accounting for investment property in the financial statement for the year ended 31st March 2021. Now they are suggesting accounting treatment. So accountants, let's say sometimes the creative accountants we have. So he has suggested some accounting treatment. So what you are required to do, so you are required to do basically, we'll read that one as well, you are required to comment, right? Comment also comes under tier 5, right? Comment also comes under tier 5. So what is happening is, student, now you are required to comment on this, whatever the suggestions. So we'll go the suggestions one by one, right? So the first one, to consider fair value of the property as at 31st March 2020 as the fair value of 31st March 2021, right? It made some decision and they are now accountant is telling what we can do is, okay, no need to show 210 million, no need to show 210 million, we will show 300 million, the fair value of the last year as the fair value of this year, right? So that is the first statement. So we will analyze this statement later. To disregard the 25% reduction in the number of tenants, rent concession given to the tenants, use the normal rental income if it was in the previous year in arriving the value using income approach 31st March 2021. Second suggestion say, so here 210 million derived how? Considering 25% reduction as well as the rent concession. But now the accountant is saying, I don't know where they have found this accountant, but now the accountant is saying, let's forget about the 25% reduction and forget about that we had COVID-19 and rent concession. We will use the same cash flows that we are used for last year valuation, right? So that is the second suggestion, right? Third one, to change the valuation technique from income approach to cost approach. The cost approach will give higher number of value than the income approach as the 31st March 2021, right? Okay, so that what they are suggesting, so we are using the income approach, no? So we have other approaches as well, market and cost. So why don't we use the cost approach? We will use the cost approach instead of the income approach for this particular valuation, right? To change the accounting policy from fair value model to cost model. That also a good solution, right? Not a good solution in the sense, accountant think that is also a good solution. What we can do, no need to fair value the property, we will go to the cost model, right? We will go to the cost model. So that also a suggestion given by the accountant. So what is the problem, student? What is the problem? The first problem is, student, what is mean by the fair value? What is mean by the fair value? So anyway, I will be rushing through the suggested solution as well. So here what I can tell you is, when it comes to SLFRS 13, what's the fair value? Fair value, let's say, no need to have the perfect definition. I will give you the keywords. Fair value is basically the price paid to acquire a liability, acquire an asset or a transfer a liability in a, let's say, in an ordinary course of transaction. Right, ordinary course of transaction, right? No orderly transaction, OVK, orderly transaction, right? Orderly transaction between market participant in a measurement date, in a specific measurement date, right? So basically, student, what is happening when it comes to this definition, right? We need to check whether these suggestions are right or wrong. We need to see whether these suggestions are right or wrong. So what I am going to do is, I am going to go to the suggested solution, right? I am going to go to the suggested solution and I will write, okay, show you what is there. First suggestion, to consider the fair value of the property as at 31st March 2020 as the fair value of 31st March 2021. As per the definition of the SLFRS 13, here they have given the definition, fair value the price that would be received when selling an asset or the amount paid to transfer a liability in orderly transaction between market participant at the measurement date. Very important. Fair value is a thing that you measure on a measurement date. So here what is the measurement date? 31st March 2021 is the measurement date. If you are using the valuation of 31st March 2020, what is happening? You are taking old measurement date rather than taking the current measurement date, which is completely incorrect. Why? Fair value is always should be measured at the measurement date, let's say the reporting date. So if you are using old fair value, it is violating the definition itself. It is violating the basic definition of fair value measurement, right? And therefore, in this case, when the investment properties are measured at fair value, the company should determine the fair value 31st March 2021, which is the fair value date, which is not 31st March 2020, right? Next one, right? Second suggestion, right? To disregard 25% reduction, to disregard the 25% reduction of the number of tenants as well as the rent concession granted and consider normal rent income same as the previous year for this year valuation. What is happening, student? Again, when measuring the fair value of the investment property in accordance with IFRS 13 or SLFRS 13, entity should ensure the fair value reflect amongst the other things rental income from current lease are the assumptions that market participant would use when pricing the investment property under certain or the current market conditions. Very important words, current market condition. So it says, student, fair value always should reflect the current market condition. So here, what is the current market condition? We have COVID-19 now. We have a problem with number of tenants. We have a problem that we have granted some rent concession. That is the current context, current market context, current condition of the market. So we have to think about that. If you ignore it and if you do the fair value, that is not a fair value. So this is violating this, whatever the description, whatever the requisition or the requirement given in the SLFRS 13, right? Current market conditions have significantly changed compared to the previous year. This reflected by the reduction of number of tenants. It is not correct to take the income without considering these changes. If it is a minor kind of a thing, let's say 2% number of tenants, only 1% or 2% reduction, that is okay. But here 25 is a significant amount and it is not allowed as per the SLFRS 13, right? So moving forward, third one, right? We have a lengthy answer. I will summarize and tell you somehow. Changes valuation techniques from income approach to cost approach. Income approach to cost approach, right? So basically, student, we have a basic accounting principle called consistency, right? Whatever the accounting applications that we are using should be consistent. It is mentioned in our general accounting principles and it is mentioned in our conceptual framework, right? And LKS 8, lot of places they are mentioning about this consistency. Anyway, SLFRS 13 also mentioning, if you are using a valuation technique, it should be consistently applied. Let's say current year income approach, next year market approach, again another year cost approach. Can you do it? No, not allowed. Whatever the valuation technique should be consistently, but it doesn't say you can't change the valuation technique. You can change, but if you change the valuation technique, you have to disclose it and you have to tell why you have done it. And when you can change the valuation technique as you wish, can you change? No. If you think by changing the valuation technique, it will give more reliable picture to the shareholders, then of course you can change the valuation techniques. Come again, whatever the valuation technique, you need to apply consistently, but it doesn't say, student, you can't change the valuation technique. You can change the valuation technique. You can. When? If you think that this will give more fair presentation, more, let's say, more reliable presentation when it's come to financial statement, of course, you can change it, right? Let's say you change it, then you have to disclose it in the annual report under the fair value measurement disclosure that this is why I have changed it and earlier I have used this and now I am using this. Likewise, you have to give a good extensive disclosure, right? So here, student, what is the purpose? Just we are getting 210 million fair value, right? Without having a purpose, right? Without having, just to increase the fair value, without having a reliable or without having a good, right, fair purpose, they are going to change the valuation techniques. They are going to change the valuation techniques and normally it cannot be done. Normally it cannot be done. We'll read. However, change in valuation techniques, its application, right? Is appropriate change in result in measurement this equally or more representative of the fair value in the circumstance. More whatever the, let's say the representatives, let's say it will become more reliable after you do this change, then of course you can proceed with the whatever the technique change, right? So normally, student, what you can do is another new thing that I want to mention, you can use multiple valuations. Multiple valuations. What is meant by multiple valuation? So let's say to value a property, you can use income approach, cost approach and market approach. Let's say you are using all three methods, income approach, cost approach and market approach, right? So you are getting some values for each approach. And what you can do is to determine the fair value, what you can do is you can wait. let's say here 50%, 30% of this and 20%. Likewise, you can have a weight and you can decide the fair value. That valuation approach also there. It is not telling that you have to only use income approach. No, you can use multiple approach and you can weight and you can measure the fair value as well. So, in business world normally we are coming across lot of that kind of weighting kind of scenarios when it comes to fair valuation. So, going forward, right, what they are saying, the company cannot just select the value given by the cost approach as the fair value. It must consider the result in both approaches and determine reasonable point within the range that it's most representative of the fair value model under current market condition. So, you can't just change the model and boost the valuation. You have to think about what method actually reflect the current market condition, right. So, let's say by changing the valuation technique, you can boost the fair value, but it is not the purpose. You have to have the fair value. Then when you are selecting the approach, that approach should be able to reflect the current market condition. So, rather than by as you wish, you can't change the model. If the valuation technique is changed appropriately by considering the above requirement, the company should provide the disclosure on the change in and the reason for it. So, I have mentioned earlier as well, right. So, here what is the conclusion, student? Okay, if you think the cost approach is more appropriate, yes, you can change, but you have to justify that cost approach is giving more reliable picture than the income approach. You can do it. Let's say you are going for the cost approach, you have to give a good disclosure mentioning how you have determined the fair value using cost approach and what is the reason for changing the model, right. So, going forward, right. To change the accounting policy, the last resort, valuations are not supporting, we will change the accounting policy. As per LKS 40 para 55, if entity has previously measured investment property at fair value, it should continue to measure the fair value until its disposal. Even comparable market transaction become less frequent. Let's say you have selected the fair value model, then you have to maintain until you are disposing. Someone can say, okay, as of this date, my market loss, there is no active market. Anyway, you don't have any option. You have to use the fair value. How? Because fair value has 3 levels, level 1, 2, 3. So, level 1 is the active market. Active market loss, that doesn't matter. Go for level 3, use valuation techniques, present value of future cash flows, whatever. You have to decide the fair value. You have to decide the fair value. So, changing model to cost model is not allowed, right. Changing accounting model policy to cost model is not allowed, and anyway you have to go ahead with the fair value model itself, right, students. Done.